Hello and welcome to this Tier Markets webinar on trading strategies. We just wanted to briefly touch on today how to formulate a trading strategy, and then I wanted to highlight one very simple one which I've used many times over almost 30 years of trading, which I think would be it'd be beneficial to any trader, but I think it beneficial to certainly the most junior of traders, people who don't have a lot of experience. As it doesn't really require a great deal of analysis. So we'll come to that in a bit. But first of all, how do we formulate a trading strategy? First thing I'm going to say is, as a trader, the last thing you want to do is have a position just for the sake of having a position. If you don't have a view, you don't have an idea, don't trade. Leave it alone until you do. Just merely having risk without having a view, without having a thought around why you've got a position is not a good thing. So always have a strategy. My phrase is plan your trade, trade your plan. And, I think that's a good lesson to adhere to. So, how do we formulate a strategy? Traders invariably will fall into one of two camps. They're going to be technical traders, or they're going to be fundamental traders. Technical traders are going to spend most of their time looking purely at charts. They're going to be looking for technical indicators, technical formations, lines of support, resistance, trend lines, specific formations like double tops and triple bottoms and all those sort of wonderful things. They're going to be looking at particular indicators, overbought, oversold conditions, relative strength indexes, MACDs, all those sort of things, all of which are going to allow them to, formulate a view, but purely based on the technicals that they're looking at. The flip side of that is a fundamental trader. The fundamental trader is largely going to ignore technical analysis, and they're going to work off the economic fundamentals of the two countries that they're looking at. So if they're looking at the US dollar against the Japanese yen, they're going to be looking very closely at the recent data releases from the US and from Japan, and analyzing that to see whose economy is stronger than the others, and formulating a view and a position based on that. And then you do, and I think this is something which we do see a lot of. Certainly, you would see a lot in the in the hedge fund community that are probably looking at longer term trades. Is where you get a combination of fundamental and technical analysis. So you'll see a portfolio manager, for example, will formulate a view based off fundamentals, but then will want to turn to technical analysis to decide where exactly to get into a trade and where to get out of a trade. Both when they're wrong and also when they're right too, where to take profit on a trade. So that's particularly common. So those are the ways to form a trading strategy. As I said, most traders usually fall into one camp or another. The second important thing to think about, regardless of whether you're looking at technical or fundamentals, is your time frame on a trade. You especially when you're looking at technical analysis, if you're looking at putting on a short-term trade, and as a trader you're not going to run that position for more than maybe a few minutes or maybe an hour at the most, don't go looking at a daily chart to go and form a view. It's probably not going to tell you very much. Similarly, if you're looking at more of a macro view on a position, and you're taking, maybe you are backing up a fundamental view with some technical analysis, and you're looking to run it for, a month or maybe even 3 months or something like that, don't go looking at a 5-minute chart. Again, that's not going to help you. Look at a daily chart, look at a weekly chart, look at something that's going to cover the time frame you're looking at appropriately. So, those are just a couple of ways of starting to put a trading strategy together. And obviously, as a trader, you will decide, what works best for you. So the one thing I wanted to look at, and again, as I said, this is a very, very simple strategy, and Doesn't really involve a great deal of analysis. I'm just bringing up my my MT5 here, my MT5 demo, just to show you. So this doesn't really involve looking at any particular charts. What I will draw your attention to is just simply the market watch box up in the top left-hand corner here. So yeah, market watch just basically lists the currencies, commodities, etc. that you're looking to trade, where they're currently trading, and most importantly for this particular exercise, where they have traded. So you can see the high and the low on the day. And what I like to look for is, on a day where there's been some good momentum in one particular direction, but that momentum has changed. So what do I mean by that? That means if something has moved down on the day, but then it stopped, it started to move back up a little bit. Or something has moved up on the day, but it stopped and it started to move down a little bit. Just, looking to see, okay, well, the momentum has stopped. Why has that happened? Maybe there's some buy orders here or there's some sell orders there, and look to trade against those highs and those lows on the day. So to give you an example, I'm going to pick something here. I'm going to pick the Australian dollar. Okay, so we've got the Australian dollar here. I've just highlighted it. See, it's currently trading around 0.6945. It's had a low of 0.6940, so we're about 5 points off the low of the day, and we have had a high of, well, it's actually 70 cents, so about 5 points off the low, 55 points off the high of the day. We've hit 40 and we've just bounced a little bit here. Now, it's not a significant bounce, but, if you didn't have any particular ideas on the day, you haven't had a chance to look at, any charts, you haven't had a chance to read any financial literature or any market commentaries or whatever, you think to yourself, okay, well, the market's hit a certain level there and turned a little bit. Is there something there holding the market up? So something I would do would be look to go long here on the change of momentum and leave a very tight stop loss. So I might buy here at 40, well, it's moved a little bit now, 46, 47, and leave a stop loss, say 5 points below the low of the day, so maybe down at 35. And I'm risking 10, 12 points here at the most. Similarly, we'll look at dollar CAD just above there. Dollar CAD has gone the other way on the day. Dollar CAD has rallied on the day. It's currently trading 134.74. It's been up as high as 134.81. So it's hit that high. It's reversed a little bit, come off a little bit. Do we know why? No, we don't know why, but must have been some sad orders there, but to cap the market out, for putting on a very short-term trade, the momentum has just changed a little bit. I might sell here or leave an offer just a pip or two a little bit higher. And again, risk a new high on the day, even a print at 134.82, or maybe, give it a little bit more room, 134.85. Again, you're risking 10 or 12 points. You're not risking a whole lot, and it's basically just a short-term momentum play. And I'm just using that as a visual, just looking at the range on the day and where we are trading now, vis-a-vis the highs and lows of the day. It can be a very quick strategy to be able to put on. You could certainly look at a short-term chart and bring up some indicators to show whether things are overbought and oversold, etc. But if you don't have that familiarity with the charts, this is just a very, very simple way at looking at where the market is now or where the market has been, and just putting a short-term trade on because of that. The one thing I would say very, very important here is we are really just trading against a new high or a new low on the day. So we're not looking to risk very much capital. Be disciplined with that, okay? Because the momentum might have changed, but maybe it's not going to stay changed for very long. And then the trend on the day is going to resume. And, you may end up getting stopped out. So make sure you've got that stop loss in place and keep that stop loss tight to where you put the position on. Don't go risking too much. The last thing we ever want to do is take a short-term trade and turn it into a long-term trade when we're wrong. All right, that is not good. Don't do it. I'm just looking at a couple of the other pairs here just to see if I can another example I'm trying to use. Something like euro. I mean, euro's had it's had a 40-point range on the day. It's 11 points off the low. It's 30 points off the high. Maybe that's not something I'm necessarily going to apply that strategy to. I suppose you could buy here and put a stop below 112.20. But something was certainly moved more. Something like Aussie has moved and CAD has moved. Even sterling to a lesser degree. It's had a 100-point range on the day, and it's a lot closer to the low of the day than it is to the high. So, maybe that's worth buying. If not here, maybe just a little bit lower down and leaving a stop at a new low. Just something to look at. It's something I look at, regularly. But you want to see the momentum change. You don't want to sit in the way of the trend of the day. You want to see some indication that the market has turned a little bit for whatever reason that is. Many reasons it could turn. But just be disciplined around that sort of trading strategy. And it's something that's worked for me over the years, and hopefully it'll work for you too. I wish you good luck.